Hello again to all my viewers. It's Mike Riley back with you again to explain a little bit more about the ins and outs of financial planning. So, this video was inspired by a blog that I wrote a couple of years ago on cross training your portfolio. Cross training is a very popular concept in physical fitness, and it really speaks to diversification within your portfolio. So, think about it this way: if you were wanted to become a better tennis player, and you hired a coach, which is always a great idea, would the recommendation of the coach be to play a lot more tennis only to become a good tennis player? Probably not. In this day and age, while the tennis part is important, they may say that you also have to increase your fitness. So, by adding some running and aerobic endurance, and also getting to the gym, picking up the weights, and building some strength. So, tennis remains your main focus while supplementing with some other things. And diversification in your portfolio is exactly the same as that. So, thinking about an investment portfolio, and an investment portfolio is a basket of different investments. If everything in here was invested in Apple, that would be great when Apple is doing well. But anyone who's followed markets over the past 100 years knows that it is not always a straight line up. So when Apple's doing well, your portfolio looks great. And when Apple's having some struggles, your whole portfolio goes down. There's nothing in there to balance it out. So what we normally do in recommending that, and we could even say, well, instead of Apple, why don't we just get 100% Canadian investments? Also, a little bit broader, you've got a few more investments in there from all the different Canadian companies. But again, Canada is a small country, and when everything's going well in Canada, you've got some great opportunities. But when things are down, then everything's down. So what we would often say is, why don't we keep maybe the majority of it in Canadian, but let's add some bonds, some fixed income instruments here, and some international equity or US equity in that proportion. So while you're still getting the great experience with Canadian investments, you're also getting an opportunity to invest in the United States and in Europe and South America and farther afield. And then you've also got some bonds, which tend to offset when things are going poorly in the stock market. Bonds tend to be up. So this is just a little bit broader. Your portfolio is cross-trained. Now, let's take that same concept and apply it to our insurance. So for many people who have insurance, the one type of insurance they have, if they have it at all, is life insurance. And life insurance is fantastic. It is a great product, and it is absolutely essential to replace income if you die. But the only way to benefit from life insurance is if you die. And statistically, more and more people are living longer and longer. And there are other things that are going to come into your life as risk factors in your financial planning, other than just dying. So if you develop cancer, or if you have a serious illness or injury that keeps you away from work, having your life insurance is no benefit because you cannot claim on it. Because as I said, you've got to die. So what if we apply the same cross-training to our risk management portfolio? So instead of having everything in life insurance, we have most of it in life insurance. That is, most of the benefits in life insurance, because death is so permanent. And we have some in disability insurance to replace our income if we're unable to go to work so we can stay home and recover, and some of it in critical illness insurance, which I talk about quite a bit, anyone that watches my videos. So this takes care of if I get sick, or if I get hurt, or if I'm diagnosed with a serious illness, I'll also get some coverage here. This is a much stronger portfolio of risk management than this one. And of course, the added benefit with critical illness is with return of premium. If you do not claim, you get all of this money back again. So you've actually added some savings into your risk management portfolio. So that's just a very high overview of just adding some diversification to both your investment plan and your risk management plan. If you have any questions, please contact me. You can click below here or on the side here, wherever the information is, and ask a question. I'm always happy to hear from people who are watching this. If you have any comments, please let me know. So it's Mike Riley here with Freedom 55 Financial, helping you gain altitude and gain confidence.